Vanakkam, Namaskar, and hello to all the viewers of this episode of Fixed Income Market with Sundaram Mutual Fund. Please also accept our New Year wishes for good health, happiness, and wealth. Shubham Bhavtu. As expected by us and market, the Monetary Policy Committee delivered a status quo verdict with a unanimous vote and a 5-1 vote on focus of withdrawal of accommodation stance. In an acknowledgement of the robust performance of the economy, MPC upped the GDP growth from 6.5% to 7% for FY24 and retained inflation forecast at 5.4%. In the United States, FOMC delivered a status quo verdict with a dovish bias, indicating 3 rate cuts in calendar year 2024. In a recap to calendar year 2023, MPC pressed the pause button on rate hikes after cumulatively hiking by 250 basis points. Reiterating the transmission of rate hikes takes time, and in the meantime, for better transmission, remain focused on withdrawal of accommodation. RBI was active in the forex markets to even out the rupee volatility, keeping the rupee tightly ranged and building back the forex reserves to around $629 billion from a low of $570 billion. India also got included in the JP Morgan Emerging Market Bond Index, which is currently tied to about $220 billion, and India will get included from 28th of June, and each month in the subsequent 10 months will get about 1% of the index money passively. Already we have seen the active money coming in into Indian government bonds. Inflation suffered from supply side dynamics as the more volatile component food remained a bugbear, while the core moderated. MPC decided to look through the transient supply induced inflation. Economy performed beyond expectations as the growth numbers were higher than the median expectation, which finally drove the MPC to revise the full year growth forecast upwards by 50 basis points to 7%. Urban economy performed better than the rural economy, which suffered from higher food inflation. On the other hand, urban consumers spend on discretionary like autos, hotels, consumer durables, etc. Credit offtake remained robust on high base, pushing the reluctant bankers to revise deposit rates higher. Credit to retail borrowers surged, which drew regulatory intervention in the form of tightening of capital norms, while the industry credit remained tepid, although still high considering at 6-7% growth rate considering the base. The higher credit deposit ratios for banks also invited regulatory foresight in form of advice to lower down the same within reasonable limits. On the global front, developed economies tightened the key policy rates led by the Federal Reserve as inflation remained sticky on account of supply side issues, low unemployment, and wage revisions, making it difficult for central bankers to bring down inflation. Japan saw inflation after decades, which resulted in unprecedented wage hikes to address inflationary pressures. Finally, climatic and geopolitical issues kept the pressure on the supply induced price hikes for both agri commodities and energy prices. After going through the major 2023 events, let us try to see what themes are likely to play out in 2024. One of the themes which we think is likely to persist is going to be in the near term continuity. We believe in the near term the continuity in theme which we witnessed in 2023, namely central banks focusing on inflation, moderation in inflation, moderate or resilient growth in larger economies, supply-induced price pressures, unwinding of global liquidity, etc. will play out in the first 2 quarters of 2024. At some time in second half of 2024, we believe a disconnect will start setting in as we see growth banks catching up due to higher rates. This is likely to be more significant for developed economies which have seen ultra low rates for almost 1.5 decades. At its peak, the negative yielding debt was $18.4 trillion. We believe that 5.5% Federal Reserve target rate is restrictive for much more restrictive for United States than 6.5% repo rate in India. The current inflation reading for US is 3% while it's 5.55% for India. So the real return in the United States is now higher than India, and this is likely to sustain giving a negative impulse to growth. Unfortunately, due to supply side dynamics and frequent climatic events and polarization of the global economy, which gets induced by the geopolitical tensions, prices of key agri commodities and energy are likely to remain volatile and possibly come under short squeeze. Due to elections in major economies like United States, India, UK, etc., spending may not be brought under control and fiscal impulse can remain large, maybe supporting growth worsening the debt to GDP ratios. Looking at all these factors, we believe that rate cuts may begin due to higher growth pangs, but will remain shallow on account of lingering inflation and poor fiscal discipline. In such a scenario, we continue to recommend our mid-duration strategy with tactical exposure to key rate duration of 7 years or higher. For investors with requisite risk appetite, we recommend active mid-duration buckets as a preferred route of investments on account of better price discovery due to liquidity, which results in a better capture of interest rate move. Products which we have in our basket are Sundaram Short-Term Fund, Sundaram Corporate Bond Fund, and Sundaram Banking PSU Fund. Keeping this in mind, we recommend investors who take positions in mid-duration buckets if they have 12 to 18 month horizon, and investors with conservative risk appetite to match their investment horizon with duration of the product or take position in conservative products like liquid or overnight. Thank you for watching this episode. Hope to see you in the next episode.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.